What really happens when mortgage rates start dropping? Most people think it's a good news for the buyers, but the truth is, it can flip the entire market overnight. Right now, Arizona's market is starting to rebalance, and the comfort market index show the buyers' momentum slowing down. But 13 out of 18 cities still favor the buyers. Tempe, Chandler, Gilbert are heating up again, and that's exactly what happens when rates dip. Now, when rates fall, more sellers also list their homes, and more buyers jump back in fast. That extra competition can turn today's buyer's market into tomorrow's bidding war if inventory doesn't keep up. For over 50 years, mortgage rates move with a 10-year Treasury, and now that the spread between them is shrinking again, we could see rates continue sliding. Now, and every 1% drops adds through roughly 10% more buyer power. So the real question isn't if rate fall, it's whether you will be ready before price rises again. Let's look at what this means for the next move by looking at the data in today's market update. Now, here's the situation that we have. This week, the comfort market index showed that the pace of change is slowing. The average monthly change is now only 2.1% drop. That is actually an improvement from the 2.6% last week that you saw in the previous video. That means the strong buyer advantage we've seen from the late summer is starting to decelerate. If you remember, it has been decelerate for the last 2 weeks, and now it's continued that trend. At the same time, 13 out of 18 major cities in Arizona still become more favorable for the buyers over the past months, even as the overall shift begins to lose momentum. The 5 cities that is still improving for the sellers, however, we can talk about Tempe, Buckeye, Fountain Hills, Chandler, and Gilbert, all seeing slightly better seller activity. And Peoria, Goodyear, Scottsdale, Santa Valley are leading the way for the buyers with softer pricing. They have a little bit price improvement and increase of supply in these cities. As a result, we now have 6 cities in the seller's market, 5 cities in the balanced market, and 7 cities in the buyer's market. This distribution shows that the Arizona is entering a more balanced phase, neither extreme for the buyers nor for the seller. What's driving the change? The key reason behind this market balance is the supply of houses in the market. So we have more homes coming to the market as the seller responds to the slightly lower mortgage rate. This is interesting and very surprising. As the interest rate decrease, a lot of people think that the only group of people impacted is the buyer, but also the seller in this situation, because that also driving the decision to list. But here's the twist. While the demand is improving for sure, it's still below the normal level, meaning buyers remain cautious and selective in nowadays market. In short, sellers are competing harder for attention, and the buyers have more flexibility to negotiate more confidently, especially in mid-priced neighborhoods across the valley. Both buyers and sellers have to be very aware of the current situation, especially when the interest rate goes down. Not just assuming when the lower interest rate the buyer has advantage, but also be careful on how the seller reacts, and therefore changing the number of available houses on the market as well. The other number that we are going to look at is a Case-Shiller home price report. We have that in today's episode. Phoenix actually ranked 18 out of 20 cities that in the report, with prices falling 0.9% month over month and 1.68% year over year. That makes the Phoenix roughly 3 times weaker than the national average, which has the monthly change of 0.3%. In comparison, so we have a Phoenix of 0.9% drop, month over month. We have a national average of 0.3%. In comparison, we have Chicago and New York are leading the national in the gain, not in the drop, but in the gain, meaning home prices in Chicago and New York is still increasing, while the South and the West, including Arizona, are seeing sharpened pullbacks from the COVID. So that's the situation reported in the Case-Shiller. Now let's look at what actually impacting the mortgage interest rates and how we can predict that. First, over the 50 years, look at this. This is a 50 years, the 30 years mortgage rate has moved in, kind of follow with the 10-year Treasury yield, which is the blue line here. However the blue behave, the green, the 30 years mortgage rate kind of follow. When the 10 years Treasury goes up, the mortgage rates also goes up. When it comes down, the mortgage rates tend to drop as well. Historically, the spread, the difference between the two numbers, normally about 1.76% point, a pattern that has strong for many years. We have 50 years of data, and we see that on average, the spread has to be 1.76. Why is this number significant? Because here's the thing, when we look at the recent years, we see that the spread has narrowed over the last few years. Since 2023, the gap between the 10 years Treasury and the mortgage rate has been shrinking. That's the good news. It's not back to the long term yet. So remember, so here's one thing right here. 2023, we have a spread of 2.76 and now we have 2.10. It has been spreading on average. It's still 2.56. So it's not close to the 1.76 yet. So the prediction is it's because the spread is on the trend to go down. The prediction is it could very well soon come back to closer to the average very soon. When? Who knows? A lot of people are predicting, a lot of big company, big bank predicting until the end of 2026, the mortgage rate is gonna continue to drop. But we're gonna keep following it to see when that will happen. And finally, what determines the mortgage rate? It comes down to the 10-year Treasury yield plus the spread, right? As you see the previous chart. When you add those together, you get general mortgage rate. So right now, as of September 2025, we have the 10-year Treasury of 4.20, the spread is about 2.10, and the mortgage rate is about 6.3. Definitely, these are something, the spread is something that we need to continue measuring and follow to see where the mortgage rate is. Because why? Because when the mortgage rate drop, it's actually changing both buyers and sellers in this market. Okay, so for the buyers and sellers, definitely watch out for the market, watch out for the interest rate, and watch out for how the inventory and the supply change in this market. Thank you so much everyone for watching, and I hope to see you next time in the next week.